Good evening. How's everybody doing tonight? Good? All right. Well, thank you, Severin Financial, for having me in. My name's Brian Marks, as Steve mentioned. I'm with Hartford Funds. So many people have heard of Hartford, the company, right? So I've been here 12 years. I live locally in the Baltimore area. So I'm happy to be down here in Annapolis with you this evening. And sharing the evening. I've worked with Steve and Steve Roth and the guys for almost 10 years now. And when we were meeting last, we were talking about getting together, talking to clients about what's happening in the market, right? So the market's obviously been doing well, and we just thought we'd kind of bring some perspective back into the market as far as volatility, psychology. So what we're going to talk about today is a presentation that we have called Media Replay. So just to clarify, everyone has a packet, a brochure in front of you as well. That's basically what I'm going to follow along here. The slides are a little bit different. So if you can see it, I'd encourage you to follow along here. If you can't, flip through the book and I'll try and reference where I'm going through from this aspect as well. I do a lot of these talks working with advisors around the country, and what we try and do is we try and do three things at these meetings. We want to, number one, have a great time, get some folks together in the community. Number two, we want to give you some things, information to provoke some thought and hopefully teach you some things that maybe you didn't know or answer some questions. And then three is just have a good meal, share some camaraderie. I'm glad these screens are down here, else everybody would be looking past me at the nice at the water. So what I wanted to do today is this. We've been running with this presentation called Media Replay for about the last, I'd say, 9 months or so, and it's really informative. It's not anything at all about Hartford Funds or the products that we offer. It's just more about investor education, because we know at the Hartford we share the same beliefs that Steve and everybody at Severin Financial is. We want to meet with clients individually, face to face. We want to help them figure out what's important to them, what's the role of their investment, and how can we get there and educate you through a plan. And we know there's going to be a lot of speed bumps along the way, and the media is what we're going to talk about here tonight. So when I mentioned some of the statistics that I talk about, a lot of the statistics and insights that I'm getting and are in this presentation are from our sub-advisor, our money manager, Wellington Management. Might be a name you have heard of, have not heard of. Most people know Hartford, but most people don't know Wellington. They're actually the ones that manage all of our mutual funds. They run $900 billion in assets under management. They're one of the top 5 largest institutional money managers in the world. They have 12 offices around the world, and they do a lot of pensions and endowments. And we work with them as far as bringing their institutional access and expertise to the retail clients, like everyone here in this room, because you need $50 million to go to Wellington Management Direct, which is just not something the average client has, obviously. So we again, exclusive money management relationship that we've had for over 20 years that helps us be one of the top mutual fund companies in the industry. We also collaborate and work with MIT. Anybody go to MIT or have friends, relatives that went there? Okay, good, I can say what I want then. No, I'm just kidding. So we work with them, right? The rocket scientists up in Boston, a lot of consumer behavior. We know there's really 2 emotions that drive the market in investing. It's fear and greed, right? Emotion puts money in motion, right? I'm not making enough money, or I'm getting killed, I can't take it anymore, get me out. So again, there's a lot of psychology that goes into the investing aspect of it, and we're going to look at some of those things as well through today. Before I jump into it, though, I always like to start out just to kind of lay out this presentation is just to get you thinking about just 2 different thinkers. One you've definitely heard of, and one you maybe haven't heard of. The first person that I want to mention here, because it kind of sets the framework, is how many people have heard of Walter Lippmann? A few hands, right? Actually, a pretty good amount. So Walter Lippmann, probably the most famous journalist in the United States from the 20s and 30s. He literally wrote the book on how media influences public opinion, and the fact that the name of the book he wrote was called Public Opinion. Walter Lippmann also coined the term stereotype and Cold War. His premise on how media impacts public opinions was that there's the world outside and then the pictures in our head, right? So the world outside, pictures in our head, and the media is the bridge between the two. So I want you guys to keep that in mind, because why is that important? Sometimes the picture that we form in our heads based on the news aren't always accurate. You know, we're all busy. This may happen based on intentional representation, but sometimes it happens because we're trying to compress so much information into our lives and trying to get the 2-minute, give me the Cliff Note version, right? Stephen, just tell me what's important, what I need to know. I have 2-year-old twins at home. Putting this suit on never felt so easy coming to work. Right? Everybody's time is extremely compressed. So we just want to know the details. But a lot of times there's a perception versus reality. The second thinker that I want you to think about is Mark Twain, which we've all heard of. We hear this quote a lot in our industry, as history doesn't always repeat itself, but it oftentimes rhymes. Right? So why are we going to talk about that tonight and the implications on the investment world? You can see this is a media replay. There's an arrow there going around in a circle. And what you'll see, and hopefully after my presentation, you'll see is that a lot of these same themes that we might be worried about or have worried about are probably going to rear their head again at some point. And we're going to look at some Time magazine covers and have a little bit of fun with that. So let's go ahead and dive in. And please feel free, raise your hand, stop me at any time. Again, we want to make this interactive. We want to make sure you get some good information out of this. So what are some of the same themes that the media tends to focus on? You'll see at the top it says economic meltdown. And I just look at the Time magazine covers. It says surviving the lean economy. The economy, is there light at the end of the tunnel? How to survive the slump. Does anybody want to guess which headline here, or Time magazine cover, is the oldest? Anybody take a guess? It's actually, if we click on him, the Big Headache 1974. The most recent is the far left that says surviving the lean economy with the piggy bank. So you can see we've had 5 economic meltdowns since the 1970s, right? The next topic that the media will tend to replay over and over again is Social Security. Can I retire? Am I going to be able to have enough money to live and retire? Number one question that people ask, one of my competitors did a study. They asked, what's your number one goal for saving? Not probably any surprise, 80% said saving for retirement. When they asked the follow-up question, are you on pace to hit your goals? Less than 25% of the people could actually answer that question to say they didn't know. So they know they're saving for retirement, yet they don't know, are they saving enough? So here's the thing that the media will jump on as well. We have Social Security, we have the retirement, where goes the 401k? Again, this always tends to make for good things as well. And you can see the same thing with the topics. They range going back from 1982 is the oldest to the most recent in 2009. And again, this is something that we're obviously fighting today, and something that the group is going to discuss later on in the event as well is Social Security and the impact there. The next is our system is broken, right? So you can read some of the headlines: healthcare, capitalism, corporate greed. These are all things that have reared their head over the time period. Most recent was 2012, one nation subsidized, and then you can see in healthcare costs going back to 1979. Now this one's probably the one that we get the most questions on, right? Debt, and more debt. I think we'd probably all be surprised when I click the button that all these happened between 1972 and 1984. I think we could probably have any of these Time magazine covers happening in the last couple of years, and something that the country continues to address. But what the main points we want to try and hit on is these themes. They tend to always repeat themselves, right? And there's always going to be a reason for us not to want to invest. Or we might question what we're doing, right? Is what I'm doing right? Should I stay with my strategy? Should I call Stephen and say, you know what, I'm just not sure what we're doing is right? That's what you should be doing. But then if that's why he's there to clarify some of those things. So any of these headlines that I put up there, were there any positive headlines? Right? There was no positive headlines on there. So again, when's the best time to invest is probably when there's a lot of fear and uncertainty. But again, if you just looked at these covers and said, wow, none of these really made me feel excited about getting into the market or buying stocks or anything, but all the while the S&P 500 over the last 40 years has averaged 9% per year. So here's the agenda and some of the things we're going to talk about. Again, a lot of this research comes from MIT and the behavioral finance, the anxiety, mistakes, and solutions. So let's look at anxiety. In the daily media storm, how many people have a smartphone in the room? Right? So I think this data right here is a little bit incomplete, because if I asked you to research something or asked you a question, we could all pull out our smartphones and find that instantly, right? But this is just showing the daily media storm. So this is average time people watch TV, and it breaks it down by local news, network news, and cable news. So 79 minutes for cable news, and this is heavy viewers, is the data that we see. So if people are watching a lot of news, the question that we ask is, what do they get? What's the message they're hearing? That's probably more important than how much time they're spending. And is it relevant? And again, can we make sure that they're making good investment decisions based on the media, or is it that perception versus reality from good news versus bad news? So this is an interesting cut of data that MIT provides to us on an annual basis. It was just updated at the end of December of last year. And this is just showing you the public's view of recent economic activity. And it probably shows no surprise that December of 2008 is when this started. And that was really in the middle or the very early innings of our worst downturn that we've all seen in our lives from a financial standpoint in the financial economy. 80% of people thought the news they were getting was mostly bad news. 19% thought it was a mix, and 1% thought it was good news. Not really sure where that 1% came from, right? And I'm not really sure why the 80% isn't higher. But you fast forward to where we are, right? Time heals all. The markets recovered nicely. And you hear where we are at the end of December of last year, a couple of months ago, and you still have only 14% of people saying what they're getting is mostly good news. And 63% say a mix of good and bad, 21% still mostly negative. What we would encourage people to think about is, since 2009, when the market bottomed, the S&P 500, or actually the Dow Jones Industrial Average, were both at lows that we had seen. The S&P 500 they bottomed out at 666 points. We're now over 2,000 points 6 years later. We've had a 6-year bull market on the economy and the stock market. And again, there's a disconnect here between the information that people are getting, or at least the perception versus reality. So that's why we continue to do workshops like this, to make sure people are informed, to make sure that there is good information and good things that are happening here in the investment landscape. And I'm sure these are things that are reinforced on your daily conversations or meetings with the folks at Severin Financial. Does anybody have any questions on this slide or anything that I've covered so far? Does that make sense? All right. So what does this all mean? So this is kind of funny. So when we don't understand something, right, with our smartphones or whatever, what do, right? If somebody needs an answer to something, we Google it, right? And if it's, so this is interesting. What MIT tells us is that anxiety effect. Is if we don't know something, we'll go to it. A lot of times if we don't know something, we immediately think negative versus positive. So here, this is a Google thread or trend that shows you how often the word anxiety was Googled from different time periods. I'll click it and it'll start rolling. And then you can see the darker it is, the more times people started to Google that word, and it goes state by state. We're somewhat okay. Virginia looks good, but here's 05, 06. We start going into the financial system, crisis, and then you can see the whole thing goes to navy blue. So again, a lot of people out there looking for information is kind of the synopsis there. And again, MIT tells us in an anxious state, we're going to go to the negative first. If we don't understand it, we tend to focus on the negative. So what are the mistakes people are making? If we're investing too much attention on the negative, we might be missing opportunities. And I'm not making blanket statements here for everyone in the room, just with some of the information that we've seen from our money managers and from our folks. Here, this is interesting. This is one of my favorite charts on here. The red line is CNBC viewership. Does everybody know what CNBC is in the room? Right, big financial publication, TV station. This spike in viewership, and the blue line is the S&P 500. It may come as a surprise to you. It may not. The best day CNBC's ever had from a viewership standpoint. Anybody want to guess?
Yeah, I do.
Yeah.
March the 9th, 2009.
Pretty close, buddy. It was actually September 29th, 2008, which close, but September 29th, 2008 happened to be the worst day ever for the Dow Jones Industrial Average. Headline reads, Dow has worst day ever. People flock to it. Google, look at the media, tune into CNBC, right? It's consumer psychology, it's consumer behavior. Next day, Dow Jones has its best day ever, gaining back 438 points. What do you think the headline read the next day? There was no headline. Right? So that's that negative versus positive, right? And what you can see is we tend to, we want to be drawn to that shiny object or bad news sells, right? And I'm not picking on the media here. It's just also, it's us in psychology. And you look at when things are at its worst, we want to tune in, right? And then you look at the market has begun to recover, and what is we as society or investors tended to do? We tend to tune out a little bit. Things are going well. We're making money. Our accounts are growing again. We're not focusing as much attention on that. There's no right or wrong strategy. Everyone should be as involved or disinvolved as you want, as long as you're working with great financial advisors that are keeping an eye on it for you. But again, it's that perception versus reality. We just want to make sure a lot of times we're our own worst enemies. So our number one natural reaction to investments is oftentimes our worst decision to make, right? So in times of heightened volatility, when the market's at its worst, people go into protection mode. When we've had a 6-year run in the market and people are saying, well, Steven, I got, the S&P did 13% and I only got 7. What's going on, So those things we want to make sure we try and kind of keep everything even keel from that standpoint. And again, we want to focus less on the negative and continue to stay tuned in. So if people aren't tuning in, what's happening? So this is interesting. So again, MIT tells if it's not clear, it must be bad. So this is from 2007, basically the same cut of data that we looked at on that good news, bad news, indifferent. And then it's showing you the S&P 500 in the Carolina blue. And then the red line is actually mutual fund investors like all of us in the room, and where if they added money to the market or they were pulling money out. So what we look at here is, if you look at these headlines, they don't look great, right? So you got Bear Stearns, you got TARP, you got quantitative easing 1, then 2, unemployment hits 10.2. All these things along the way challenging us as investors, right? And then you got the BP oil spill, flash crash, Greece situations. This is showing you people have pulled money out of the equity market all along the way down, and they continue to do that even after 2009, the date Steven referenced, which ended up being the all-time low of the market. You wouldn't have known it at the time, but 1 year, 2 years after the dust has settled, even into 2010 and 2011, there was plenty of opportunity and plenty of room to run if you wanted to wait for things to more stabilize, if you will. So people are pulling money out of the market. And the number one mistake that we see folks making is selling good quality investments based on short-term volatility. So the money's going out of the equity market, and again, everybody's got their own asset allocation strategies, but where's it going? It's going into fixed income, or it's going into cash-like investments. So from that same time period that we looked at, $661 billion of client assets went out of the mutual fund industry, out of domestic equity funds, or equity funds, actually yes, domestic equity funds, into bond funds, meaning no equities, meaning either corporate bonds, maybe municipal bonds, whatever it might be. You saw a huge wave into that. And even here where we stand in April of 2015, many years after the crisis, I still will talk to investors that say, you know what, I don't know why I have that much in fixed income or that much in bonds. We just made the change, and maybe we haven't gone back and revisited it. How many people in the room are happy with the rate of return you're getting on your CDs or money market right now? Right? You guys hit it nail on the head. It never fails. Whether I do this in Annapolis, Bethesda, Baltimore, Frederick, I ask that question and I never even get an answer back. Everybody just starts laughing, right? It's a joke. And if interest rates stay low, which they probably will for a little bit longer, and even if they go up, it's probably going to be minimal, there's real missed opportunity cost for having too much there. Now, I'm not bashing it. Our firm doesn't bash it at all, having CDs, cash investments, because it's part of the financial planning picture. But how much should you have there? If you don't know the answer to that, the gentleman in the back can help you out there. If you've started to accumulate and you think you have too much there could be other things that you could invest in that may or may not be appropriate. All we're saying is if you haven't reviewed it or looked at it recently and you have a lot of cash built up, you're not earning anything, inflation's there, you got to pay taxes on it, you're losing actual purchasing power. So one takeaway that you might want to think about as we discuss just the variety of different things that are happening. And then the last thing here on mistakes is risk aversion. So MIT tells us we're much more likely to focus on the pain of loss than the pain of gain. And this is the best story that we get is, let's say we all leave here. Let's say I leave here with Steven and we walk up the street and say, hey, let's go grab a cup of coffee at the Maryland Inn at the Starbucks up there. We're walking up the cobblestone. I walk up there. I see a $20 bill sitting there. I think, Pretty good pickup, right? Lucky day, I pick it up, I put it in my pocket. I'm excited that I got $20 in my pocket. I say, hey, Steven, you know what? Coffee's on me, buddy. I got this one covered for you. We get up there, we order, I pull the money out of my pocket, it's not there, right? Money fell out or I lost it on the walk up. What MIT tells us is we're 2 to 3 times more disappointed about that loss than we were about the gain, right? And we're in no better place than we were at the beginning when we left here to go buy a cup of coffee. But that pain of loss stays with us 2 or 3 times longer than actually the gain. And that's 100% true for investing as well. If it wasn't true, we all wouldn't focus so much on 2008. Because what we're showing here, and I know the guys have some information on some other things on this as well, this is just year by year returns of the S&P 500 going back to 1926. So this is, let's just say, from January 1st to December 31st, did we win or did we lose, right? Did we make money or did we lose by owning the S&P 500? And knowing these guys for the last 10 years, I know nobody in the room, if you're clients with them, is 100% in the S&P 500, but it's just a good gauge of how did the market do, you know. And what you can see here is, this is in your booklets as well, is there's 63 positive marks. So the 63 years of the, 65 years you were positive and 24 years you were negative. So if you can't see this, let me just tell you what page it's on in your booklets, because I think this is a very important. 13? All right, thanks. All right, so it's on 13, and what you can see is on the far right-hand side are just some of the things that I'll mention. 65 years positive, 24 negative, 73% of the 73% of the time you were positive from a rate of return standpoint. Not bad, right? 3 out of 4 years, right? If we could win 3 out of 4 games we played in sports or whatever, we'd be pretty happy about that. And then what you can see, the average annual return, 10.12. So this is the life of the S&P 500. So what we want to try and do is extrapolate that and say, okay, if you got a 10-year window and you know that 3 out of every 4 years is positive, historically, you say, all right, if I own something for 10 years, there's probably going to be 2, maybe 3 years where I'm not happy with the investment that I've been placed in, right? And we just want to make sure people are aware of that on the front end. It doesn't mean it's a bad investment, it just could have been bad timing or you need to hold longer for things to come into fruition. But I'll take the odds of having market exposure when you've made money 73% of the time, the long-term averages are 10%, and then when you look a step further and you say, okay, how many times did the market gain by more than 20%? It's 33 of those 65 times. And how many times did the market lose by 20%? It's 6 times since 1926 on a year-by-year basis. So we're just looking at, January to December. And again, but we want to focus, my story about walking up to Starbucks, we want to focus on that negative versus the positive. But again, some really good things happening in the market and some good things happening by owning equities long-term. The reality is again, we're an insurance company at heart. I represent the mutual funds. We do a lot of studies on longevity. And the things that I always mention is, if you're 65 years old right now in the U.S. and you're married, does anybody know what your percent chance of making it to age 90 is? So 65 years old, what's your chance you're going to make it to age 90 if you hit 65? 63% chance you'll make it to age 90. 36% chance if you're 65 you make it to 95, right? I see some couples patting each other. Yeah, good stuff, right? So the question we need to ask, right? We're not doing our job is if we hit 65 or you're approaching or in early retirement, we need to plan 20, 30 years in some situations so people will get to that, retirement or whatever they want to do, and they turn that paycheck off potentially, and they say, all right, I'm out of equities, I'm done. Well, probably not unless you have an exorbitant amount of money. So again, we just want to make sure, and I know the approach that these guys work with because I've worked with them for a while, is we're going to look at the whole assets. We're going to look at Social Security. Are you lucky enough to have a pension? How much income do you need in retirement? What are your expenses? All those things go into how we craft or how they craft an asset allocation plan. Because if you don't need to get 8% and suscept yourself to more volatility, why would you do that if you only need to shoot for 5 to live comfortably? They develop a plan differently. And some of you in the room that are clients, this is all just reinforcing the things that they probably already mentioned to you. Does anybody have any questions on that or anything that I just touched on? Good? You guys still listening? All right, cool. All right, so here's another thing on the mistakes, and I'll speed it up here. So there's been 5 different times in the last 40 years where the market's dropped by 30% or more. We highlighted them, put a couple of bullet points on there of what caused it. There's really no rhyme or reason, right? Mark Twain, history doesn't repeat itself, it oftentimes rhymes, but you see the 30% drop or more. Why did it happen? Housing crisis, .com, Black Monday, the earliest one there was the oil embargo, having to get gas on odd even days based on your license plate, or odd even based on your license plate. So all this means is that there's always been challenges along the way. That's not going to change. What we think is interesting is taking a longer term approach, regardless of where you are in the retirement game. And this is showing you the last 40 years. The gold line is cash. So this is if you just wanted to stick your money under the mattress, put it in a savings account, and just let it sit there. Now, albeit the last 30 years we've had short-term interest rates over 10, 12%, so that was a benefit to that. Short-term interest rates right now are 0.25, even worse on cash investment. The top line is just owning the S&P 500, which we looked at, all equities. We wouldn't encourage anybody to do that because you get a lot of volatility, right? You made the most money, but you probably lost the most hair and had the most stomach aches along the way. The green line is the bond investment. This is just owning fixed income, so no equities. Again, what we would caution over the last 40 years, 30 of those last 40 years, we've had a falling interest rate environment, which is extremely kind of wind at the back for the bond market. So it's been a very favorable environment. We're staring at probably a first interest rate increase we've seen in 6 years in the face at some point this year. That's going to be a big headwind for fixed income. And then the red line is the reactionary investor. And this is showing somebody that's 100% in cash, or 100% in the market, and every time the market drops by 30%, so those panic buttons we saw on the previous page, they move out and go to cash for 2 years, right? So there's 5 buttons on there, and there's 2 years they wait after each time the button hits. So they were out of the market for 10 years in essence. So 30 years of the 40 years on the illustration, they were there in the market, but missing those 10 years, they missed half the returns. Does that make sense? So we don't know when's the best time to be in, when's the best time to be out. The best strategy is what we would say the Carolina blue line, which is just, which is bad probably for the Maryland guys in the back. I shouldn't have said that, but the light blue line is the balanced investor owning bonds and stocks. So just in a mix of that, you mitigate some of that volatility. You take some of that emotion off where you're not getting this extreme highs, but you're not also feeling the extreme lows. And then the last, is the solutions page. And this is just some of the things that, again, I represent Wellington Management, which is one of the top 5 institutional money managers. We're lucky enough to have worked with them at Hartford Funds for over 40 years, going back into some of our annuity products. So I mentioned in the beginning, we've been working with this presentation for 9 months. So when we started this, they titled it Headlines You'll Probably Never See. And there's 200 research analysts at Wellington from our institutional money management firm, researching next trends, what's happening in technology, healthcare, all these innovation areas. And what we put on here was 4 of the themes that they mentioned to us that they thought were very prevalent for us to get at. Now, most people probably have heard about 3D printing in some degree now that it's, 60 Minutes did a show on it probably 2-3 months ago. But these are some trends and some things that are happening that maybe aren't picking up the same news coverage as some of the other things, just reporting good news, bad news in the market. So there was actually the 3D printing. There was a jawbone that was printed, which is shown there, that was implanted into an 83-year-old woman sometime within the last year. This U.S. energy independence is a big one. The U.S. Is a net exporter of refined petroleum, and natural gas may not be far behind. If current trends continue in population, we could be energy independent within the next 10 to 20 years. That's very, very significant for us. The other thing, the mirror that looks inside of you. So this is interesting. This is actually a leading research firm has invented a mirror, web-based cameras that can actually monitor cardiovascular health by just standing in front of it. Blood pressure, right? And different respiratory rate, oxygen levels. So think about having that in your home, right? And when I speak on this, some people say, hey, you know what, Brian, that's too much information I want before my first cup of coffee, right? Standing in the mirror in the bathroom. But just think about it a step further is if we could get early detection, how often would you see the healthcare provider? Maybe you can find out if there's something wrong and just how we see, you know, healthcare and medicine and things like that. You know, some really interesting and innovative things happening. This bike share program, transportation without ownership, 130 bike share programs, 200 cities around the world, estimated flight of 237,000 bikes. So some shared transportation. So again, some really good things happening. You'll never see these hit the mainstream media. We think it's our job to say, hey, here's some things that are happening. This may or may not impact your portfolio, but we want to bring things to everyone's attention there. On this slide here, this is probably the most important, and this is in your booklet. Let me tell you what page it's on so you guys can earmark this. 18, man, you guys are good. So last page, so long-term behavior, it says, and this is where your advisor can help, and this is where I'll put a plug in for working with a financial advisor. So Hartford Funds, we're one of the top 15 mutual fund companies in the industry. You can only buy Hartford Funds, the firm I represent, through financial advisors. The reason is we believe in the power of a partnership with a financial advisor. And there's no better illustration than what's on this page or the page I just told you to look at. It's the same thing. And what this shows, they actually messed this up. This should be in percentages, but this is showing you over the last 30 years, the S&P 500 has averaged 11%. Yet the average equity investor has only gotten 3.79% rate of return over that 30-year period. And I'll ask you all the same question I ask all the groups. Why do you think that is? Why has the market done 11% and the average investor only gotten 3.79? What's that?
Fear and panic.
Yeah, that leads right to it. The real reason to that, which is fear and panic, is they hold their investments for less than 3 years. They come in and say, long-term money, put me in a great allocation plan, let's think long-term, and then when you get challenged by a 2008 scenario or just normal market volatility, because on average we have a 10% drop once a year, people sell good investments based on short-term volatility. They don't have somebody holding their hand along the way saying, you know what, it was just bad timing. Still a great fund, still a great investment, whatever, let's continue with that. So I think that's the big thing that you can work and take from an advisor, is they can keep you in those investments. I just look back at international investing. Last year, everybody thought international investing was going to be a great place to be. We look at inflows into the mutual fund industry, ton of money goes in there, it lost 5%. How many people bailed out of it? Through the first quarter data, a ton of people. Where's the international market so far year to date? Up over 8%. So if you sold at the end of the year, you've missed opportunity. You bought, it didn't work out, let's sell and go to something else. Well, if you were a little bit more patient and you worked with a good advisor that said, hey, you know what, this is a good investment, we got to have a little bit longer term focus. The most difficult thing any of us in the room, whether you're an advisor, whether you're the client, is extending our time horizon. We all want instant returns, instant gratification, and there's going to be challenges along the way. It's actually worse for fixed income investing with people chasing yield and chasing return. So again, 30 years of history of the market, bond and equity, major dislocation when people try and do it themselves. So that's why we only work with financial advisors, because we want to work with serious long-term investors. Your advisor can help review the portfolio, provide perspective, act as an emotional coach, help you avoid some common investment themes that I mentioned. Again, for those of you that are clients, this is all probably a review, but it's like repetition learning. We all can benefit from this. Summary of the things that we hit. We talked about anxiety and some of the MIT research there, some of the costly mistakes that people are doing, selling good investments based on short-term volatility, too much money in cash, and then just some solutions of some things that you may or may not have in your portfolio. We'll start and end with the wheel here that we talked about. Mainstream media, tendency to report on imminent market collapse often leads to panic decisions. That's that fear and greed. We need to make sure we're looking at the media. What are we getting? Digest it. Make sure we're not making bad investment decisions from that. And your financial advisors at Severin Financial can help you with that.